Ladies and gentlemen, thank you for standing by and welcome to Global Small Companies Fund Update and Outlook webinar. At this time, all participants are in a listen-only mode. Following the presentation, there will be a question and answer session. We will be taking questions online via the web panel. To submit a question online via the web, please type your questions in the Q&A box located on the bottom left of your screen. Please be advised that this webinar is being recorded today, Thursday, 12th of November 2015. I would now like to hand the webinar over to your first speaker, Ms. Leah Zell. Thank you. Please go ahead.
Good afternoon, everyone. It's Damien Crowley, actually Head of Distribution for Pengana. Welcome to our webinar on our Global Small Companies Fund. Just by way of background, just to remind you, we launched the fund on the 1st of April this year, so we're now sort of 7 months into the performance. But obviously, Lizard Investors are the investment manager, and they've got a 7-year track record of managing global small companies' monies. Joining me today are Leah Zell, who's the CIO, and John Moog, who's one of the portfolio managers for the strategy. So I'll now pass over to Leah, and then I'll come back and wrap up at the end. Thanks, Leah.
So we are global small cap specialists. I've been active in this space since the 80s. We think that the opportunity set in global small caps is extremely rich and has become even more attractive since the GFC. Our universe is overlooked and under-researched. It's quite large. I'm on slide 2. And because of the dynamic nature of the opportunities that we find and our ability to source all over the world, we feel that it is a perfect strategy for active management. Page 3 shows you the size of our universe and that the vast majority of listed equities are in fact small caps. This slide overstates what I would call our investable opportunities. We think our investable opportunity set is approximately 5,000 names, of which we focus on under 500 that meet our criteria and manage a portfolio of between 30 and 50 names. So we're extremely selective. The one point I would make about this slide is that it represents to some degree the globalization of the equity markets, because about 75% of the new listed equities over the last 20 years are outside of the United States. Slide 4, I'll just go through this very simply. It's well known that small caps are alpha generators and that over the cycle they produce higher returns than large cap equities. And again, one of the reasons why this universe has become increasingly attractive is with the concentration of pools of capital since the GFC and the fact that managers are handling larger and larger sums. Our universe has become increasingly orphaned, which means that the opportunity set for managers like us who are willing to constrain our capacity and place and invest in what in our best ideas, the competition has definitely decreased. We can skip to slide 6. The relationship with Pengana goes back 15 years. Russell Pillemer and I first met each other when he was an investment banker with Goldman's in New York, and I was a partner of a small cap specialist company in Chicago that managed, well, today it manages about $30 billion in small cap equities, and we sold that firm to Bank of America, and Russell was the investment banker on that sale. So he and I got to know each other very well at that juncture, and the good thing about that history is that Pengana and Lizard share a common philosophy that goes back to the history that Russell and I have together. Slides 6 and 7 go through the similarities and the congruence that the two firms both subscribe to. We believe in benchmark unaware investing. We believe in generating our own ideas. We organize our research process by opportunity as opposed to by geography or by industry. We are both value-oriented, and we don't turn the portfolios a lot. We have 3 to 5 year time horizons, and of course, we subscribe to a highly ethical philosophy. I think that goes without saying. And at this point, I'm going to hand this over to John Moog, who is my colleague and partner, to discuss the investment process on slide 9.
Great, thank you. So, what we have designed is an investment process that we hope attacks the inefficiencies in the small cap universe, and our goal is to deliver a reasonably concentrated portfolio of businesses that we think will dramatically outperform the index over a long period of time. And we think the universe is uniquely situated to do that, given the lack of depth of understanding of some of the businesses that operate in that. So we break our investment process down into various pieces to take advantage of that. The first is sourcing ideas. The second is how we do diligence on those ideas. And then we have, obviously, decision-making and how we execute those decisions. But I think I'd like to really focus on what types of businesses we try to source and why, and how we find them. On slide 10, it talks a little bit about the universe and the narrowing of the universe in terms of how we look at it. The 50,000 stocks we talked about before are really boiled down to about 5,000 stocks with the liquidity that we would be interested in. And what it really comes down to, there are about 300 stocks that really match our quality criteria. So on slide 11, I think is critical, and I think critical for the sourcing of ideas in our fund. I think we tend to focus, 2 core investment philosophy for us is really, 1, we focus on preservation of capital and downside protection in investments, and how we do that is really by focusing our time on our best ideas. So what we think about downside protection and how we generate returns over time are focusing on really high quality businesses and buying them at discounts to intrinsic value. From a business quality standpoint, we tend to only look for businesses that have large competitive advantages, have balance sheets that are sustainable, have management teams that are well aligned with us, and critically in some of the markets we operate have good corporate governance. So if any of those 4 qualitative features are lacking in a business, we eliminate it quickly, and that's how we move down to a list of about 300 businesses that meet the qualitative criteria that we would be interested in investing in. And that is what comprises what we call our watch list. And Leah, myself, and David, the other portfolio manager, have been together for 7 years. The watch list is really our institutional knowledge and a list we use to generate ideas as they become attractive from a valuation standpoint. The other place we tend to find new ideas is really looking where there will be misunderstanding in the market we operate in, which we think these opportunities are rife and always being generated. So we look for businesses that may be misunderstood for reasons, maybe a broken IPO, corporate spin-offs, corporate reorganizations, lack of sell-side analyst coverage, a variety of different situations in which there can be a misunderstanding about a business. I think we think about a lot of these situations as taking advantage of time arbitrage. In many of these situations, there'll be investors focused on short-term issues. We try to look out 3 to 5 years and really value a business based on its long-term earnings power and use other investors' short-termism to our advantage. So that's the sourcing of the business. It ends up with a portfolio of reasonable concentration. So we have listed on slide 12 that the range of number of investments will be 30 to 80. I would say we would like to focus here on more on 30 to 50 investments. We want to run a portfolio that's reasonably concentrated, but we don't want to be taking too much risk in any one company. So there is a maximum position size of 10%. Generally, positions will be sized from 2 to 5% of the portfolio. Up here we have flexibility to take the median market cap up to $3 billion. Over the life cycle of the 7 years we've been investing together, the median market cap's been between $1 billion and $1.5 billion. Cash in the fund can be up to 20% of the fund, but we plan on investing this as largely as a fully invested vehicle, and hopefully over the life cycle of the fund, cash will be about 5% of the fund. And I'm going to pass it over to Leah on slide 13 to talk about one of our investments and hopefully give an example of how we actually put this in practice, and it may clarify some things.
Okay, so slide 13 is about Moleskine. It's a brand name that I would hope that many of you recognize. They make books, writing notebooks, and associated accessories. This is a business that did not exist. Actually, they do a lot of PR about how Ernest Hemingway wrote his books on moleskins, but the brand was defunct when some Italian entrepreneurs in the late 90s bought the name and resurrected the company. They brought it public in the summer of 2013, and as you can see, the stock immediately fell out of bed. They took the opportunity to go public to restructure some of their distribution. We went to the IPO luncheon, got to meet management, thought that it was a very high-quality company with very high margins, but because they were doing some investing to grow the business initially after they went public, and as happens in IPOs, there wasn't a loyal or very knowledgeable investor base, so the people who bought it on the IPO and saw the numbers coming in below expectations bailed, and that is what interested us. This would be a great example of a high-quality company but a broken IPO. As you can see on the chart, we bought it for our U.S. product before the launch of the Pengana Fund at the end of the summer of 2014, when it had fallen approximately 40+% from the IPO price in a year. We then dug into before we bought it, we dug into the question as to why they were restructuring the distribution. For us, that was the key due diligence issue, and concluded that they were improving the prospects of the company long term. All through 2014, they reported negative comps. In the fourth quarter of 2014, it turned around dramatically, and you can see on the chart when they announced their fourth quarter numbers, having been down every quarter since they went public. In the fourth quarter, suddenly they were growing revenues and earnings 20%, and they have exceeded expectations now for 6 quarters in a row. We added to it after that announcement and added the name to the Pengana Fund when we launched this product in April of 2015, and they just again reported earnings last week, and we think that they're doing a great job. It's still a very small company. We bought it initially under $300 million U.S. dollar market cap. It's still under $500 million U.S. dollar market cap, and we think they have great opportunity to expand distribution both through channel, because they have wholesale, retail, online, and B2B, and also geographically. So this is, for us, it's 15 times earnings, growing revenues and earnings in excess of 20%, and very much below the radar screen. So we're very happy with it. I'll now hand it over to John to discuss slide 14, which gives you an example of a different. So the first, so the Moleskine is an example of what we call time arbitrage, where it looks optically expensive, but if you look out 2 years, you can really see that it's a very, very good value. This is an example of another technique we use to source ideas by opportunity.
Yeah, with that, I think what Leah is referring to, or I know what Leah is referring to, what we call is been to the movies before. Rami Levy is a discount food retailer in Israel. We have long been fans of hard discount food retail. We have studied Aldi since the fund's inception in 2009. Although Aldi is a private company, you have seen similar businesses pop up in different regions around the world. There's this very successful business in Turkey, and we were able to find a business comparable in Israel, which is Rami Levy, and we're very big fans of this business model. We think they have generally can create large competitive advantages against incumbents that tend to have high fixed cost structures, balance sheets that are no longer competitive, and really have an opportunity to come in underneath the traditional incumbent, take share, and generate very high returns. And I think one of the things that's really blown us away, and one of the reasons we're such big fans of these businesses, is that these businesses tend to generate ROEs in excess of 50%, given their very low capital requirements in the business. So Rami Levy is a business, again, in Israel that we knew this, we tend to know the business model, and we can see it rolling out in other places, and it's something we've seen in various industries across time. And so for us, what's very exciting about Rami is it's a business we've known for a while, we've been invested in for a while, and since we've invested, the thesis has really started to play out. They've gone in and taken share from the incumbents. They're still mid-single-digit market share in the region. But what's critical is there are two large incumbents. One is now in bankruptcy and being forced to think about liquidating units and various other measures that are going to allow Rami to continue to grow share, continue to improve profitability, and really compound value, in our view, over a very long period of time. So we love to find these situations where we can invest in businesses that we think can compound for long periods of time and really get an understanding of why this business has a competitive advantage, because we've seen it roll out a similar business in Germany for the last 20 years or in the UK for the last 5 years. And we think it's really interesting to talk about this now, given all these continued investment and growth in the Australian market, because it's a very similar situation. So I think those are two examples of how we find investments, what type of investments we're finding. Rami, for example, is a small company in Israel. We don't think there's no institutional support outside of Israel from an investor-based standpoint. There's no large sell-side firm covering the business. So we think these are the types of opportunities if we look hard, we can find that are really under the institutional radar for most investors. And we think what really allows us to create a differentiated portfolio that will add alpha. With that, I would love to turn it over to anyone in the audience who has questions, or maybe back to Damien for a few comments.
I'll just make a couple of comments as we just give you time to think of some questions. Just to summarise, I think firstly the universe is particularly attractive. I mean, you want to be in spaces where there's high alpha and there's not crowded trades, and we think that's certainly the case. And I think then you want to be to take advantage of that, you need to be structured appropriately and have flexibility in the mandate, which this fund does, being benchmark unaware, and also you have to have people who are experienced, obviously, in understanding the space and built up an institutional knowledge. We might just go to slide 17 and have a look at the portfolio. So there's the portfolio as at the end of October. John, there's about 12% cash, 11, 12% cash.
Yeah. So I think when we look at the portfolio today, I think what you'll find here is a broad geographic mix, which we will tend to always have in the portfolio. So you'll always be getting a broad geographic and currency diversification within the portfolio. I think the other key point on the 12% cash is that we have recently had a 4% position in Japan, which was a top 5 position on the right-hand side bid aisle, was bought out by a larger competitor at 140% premium. So we are currently backfilling that and adding some more equities into the portfolio. But I think what we want you to take away is you will always be getting a diversified geographic and industry mix within the portfolio, but all are comprised of unique individual investments that we have sourced and we think tend to fall under institutional radar for almost all other investors.
John, we've got a question from a New South Wales advisor, just asking about what do you think is the capacity of the fund and the strategy?
we've limited the capacity, and I think I'd like Leah to jump in on the capacity constraints, but we believe this is inherently a capacity-constrained opportunity because we do want to maintain a concentrated portfolio. So our capacity in this strategy is $500 million US. We've committed both with Pengana to close it at that level.
We have a U.S. product. This product does not invest in Australia. It is therefore represents for an investor who has a significant allocation to Aussie equities a totally diversified opportunity. The U.S. product that we manage is a hedged product for various reasons regulatorily that reflect conditions in the U.S. market, but that product does not offer U.S. equities for a similar reason. Therefore, from a capacity perspective, there will be about 50% overlap between this product and the U.S. product because we don't offer U.S. equities in the U.S., and consequently, we consider our capacity in the U.S. to be about between $1 and $1.5 billion, and this product is going to therefore take up approximately 20% overlap capacity.
And I think philosophically, we just want to reinforce that we are setting this fund up to generate alpha and for performance, and we know over time more and more dollars lower fund's ability to generate returns, which is why both Pengana and Lizard are so focused on constraining capacity and capital in the fund.
I think we all subscribe to the belief that the weight of money is the enemy of performance, and we wish to be, we are significant investors in our own product, and therefore are more focused on returns than on asset gathering.
Leah and John, there's just another question here from Queensland. Do you have any concerns about the corporate governance around the world?
I think governance for us is absolutely critical. It's one of the key things we focus on when we're analyzing a business. I think, in many developed markets, especially the U.S. and Australia, we take minority shareholder protection a bit for granted. So governance for us is a critical issue, and unless we can get very comfortable with it, it will eliminate any investment for us. So absolutely, we think it's an issue, and it's something we spend a lot of time focused on.
I would say that our U.S. product has been approximately 80% developed market, and over time approximately 20% emerging market. We are, because of the corporate governance issue and because of our small cap orientation, for example, when you look at the geographic exposure to Asia ex-Japan, that will represent Singapore, Hong Kong, and Korea, with one small position in Thailand. We know companies in Brazil extremely well, and there's a handful that meet our corporate governance criterion, but we are not an emerging markets fund, and we would consider in certain cases emerging markets exposure, but generally expect to be able to buy the company at a discount, although again, since we're only owning 30 to 50 names, everything is on a case-by-case basis.
We've got another question here. I'll read it out. Tim Byrne from 72 Financial. The fund has largely underperformed the benchmark since inception. Do you think the investment ideas currently in the fund will pay off, or are you looking at other ideas?
We've had, I think underperformance has come from a couple places. We've had a few stocks that have declined, and then we've also been underweight the U.S., which has outperformed the index slightly. We're still confident in almost all of our investments. So we're still quite confident in all the investments we've made. The stocks that have underperformed, we have analyzed and made sure our thesis still holds. And so we are always looking to add new investments into the portfolio. We have some cash we would like to get to work, but we are quite confident in our investments, and should we no longer be confident, we'd sell them out. But again, we're investing over a 3 to 5 year time horizon, so a month or two of underperformance is not something we focus on. Again, we do invest in a benchmark unaware basis. We are very focused on 3 to 5 year time horizon, and that's what we spend our time thinking about.
And with our U.S. product, which we've been running for 7 years, we have outperformed the benchmark over 1, 2, 3, 4, and 5 years trailing, with a net exposure to the markets of only 60%. So we're really not worried about a few months. And we're not, we don't manage this. We do not think about our portfolio on a month-to-month basis. We think about what we're doing on a multi-year basis. And if we have an issue, we know that we have an issue, but it's generally not vis-a-vis a benchmark.
Leah and John, another question from Tim from 72 Financial. What impact do you think a U.S. rate rise may have on your portfolio?
That's always a challenging question to answer, but I think a rate rise, I think from my perspective, a U.S. rate rise will cause a near-term activity, a near-term flurry of activity in the global markets, which by and large will be just that, near-term activity that won't really have any long-term implications. I think we would look for any dislocations as an opportunity to add ideas or add to names in the portfolio, and I think specifically related to portfolio companies, I don't think there's much direct exposure to U.S. interest rates.
Generally, we construct our portfolios bottom up, and we look at the drivers of individual companies and individual industries. To the extent that we have what could be called macro views that inform our selection process, they are similar to what John discussed with Rami Levy, which is secular changes in industries over time that we believe have long tails of multiple years, and you would not see us, for example, rush into India because Modi has been elected there. You will see us buy an Indian equity because we think it's a high-quality company at a reasonable price, and Modi's election might actually be a cause for us to exit the position because because the enthusiasm has driven up the valuation beyond what we think is intrinsic value. So I would say the U.S. rate rise is everybody's focused on it, but the companies occupy much longer. We're looking for companies that we think will be around in 10 years, will compound value, and will will be much larger 5 and 10 years out than they are today, whether or not their cost of capital on the margin has changed.
And I think the thing I'd like to add to that is just, given our investment approach, our focus on what we perceive to be high-quality companies and things we can understand, we don't do a lot of banks. Our financials are very simple, and we don't have many companies with excessive amounts of debt. So direct impact from interest rate rise on the companies in the portfolio is quite minimal. I think that's.
Yeah, and I would just also finally add, our turnover ratio has historically been under 40%, which means that our holding period is 2 to 3 years, and therefore we are always taking the long-term view.
Leah and John, just another question. Are there any industries that you don't invest in?
Absolutely. I think just to follow on to that point, I think we just, what it really boils down to for us are focusing on businesses that have high barriers to entry and can earn high returns on capital over time and have good balance sheets that we can understand. So we tend to stick away from commodity-related businesses. We tend to stay away from complex financials. We tend to stay away from biotechs that are losing money that we don't understand. So I think we always prefer simple businesses that we can understand, that we understand exactly how they deliver value both to shareholders and their customers, and we try to keep it to that.
We also stay away from some geographies. The best example would be Russia. We haven't participated in Russia for simple reasons, and that is we can't get comfortable with the corporate governance. We spend a lot of time doing what we call ruthless elimination. If there's a reason we can't be comfortable, we move on quickly.
Unless we have any further questions, everyone, we might wrap it up there. Thank you for joining us today. There'll be an email sent out to you with a link to the webcast today, and there'll be CPD points attached to that, of course, as well. So thank you again, and look forward to keeping in touch. Thank you.
Thanks, guys. We appreciate it.
Ladies and gentlemen, that does conclude our webinar for today. Thank you for your participation. Goodbye.